You do not need technical indicators to trade stocks, and the majority of alerts and signals out there use these technical indicators. Now, before you click away thinking that this will be a biased video on trading, technical indicators can work and alerts and signals do work for some people, but I'm just here to break things down for you. And even if you're knowledgeable in technical indicators, hopefully you can still learn something. Technical indicators are mathematical calculations or pattern-based signals that traders use to get an idea as to how a particular stock price will move. They use this to gain an edge so that they can better predict the future price movements and then profit from them. So you have these math-based indicators which calculate different numbers for you to use in your trading, and you have these pattern-based indicators like candlestick patterns. But what does any of this mean? It all just sounds like nonsense. So how do traders use it to gain an edge? There are hundreds and thousands of different technical indicators out there, and generally they're put into groups like trend following, momentum, volatility, volume, and tools for identifying support and resistance. But for this video, none of that matters, and we're focusing on how it's calculated. So what magic information do they use to calculate these numbers for you? Well, they use price and volume. That's it. Here are a few of the most common indicators so that you get a better understanding of what I mean. There's simple moving average, which takes the average of price points over a period. Then there's the exponential moving average, or EMA, and you calculate a multiplier using an arbitrary number essentially, and then the EMA is the close price times the multiplier plus the previous EMA times 1 minus the multiplier. So some more numbers and just the price. Then you have the VWAP, or the volume weighted average price, which is the sum of volume times the price divided by the sum of volume. So you are using volume and price. And then you have ones that use a combination of simpler calculations, such as Bollinger Bands, which are the 20-day simple moving average as the middle line, plus or minus the 20-day standard deviation times 2. Standard deviation is just how far from the average a number is. RSI, or the relative strength index, is 100 minus 100 divided by 1 plus the average gain divided by the average loss. So this is just using price movements because the average gain or average loss is just a difference in price. All of them use price and how price has moved, and or volume, which is the shares that are traded. Now you have this information, what do you do with it? Traders will develop strategies using the information to identify times to buy or sell a particular stock. So common ones that people use are 9 EMA crossing over the 30 EMA, or price crossing over the VWAP, which is the volume weighted average price. But there are endless ones out there that people use, and these are what would be called alerts or signals to buy or sell these stocks. Wait, hold on, let's take a step back. If I throw price and volume into this technical indicator machine, it's going to spit out to buy or sell a particular stock. Doesn't it seem kind of ridiculous to blindly accept this information? What is it based on? How am I actually making this decision? Let me give you an example. If you took all of the scores for every test and exam that you've ever written and put it through a big calculation machine that spit out whether you were going to pass or fail your next exam, would you just accept this information? Would you not write your next test because you were told that you were going to fail? There are other factors to consider, like how much sleep you got the night before, or how much you studied, or whether or not it's on something that you actually know about. Just as with stock price movement, there are other factors to consider, like the market cap, or the float, which is the number of shares that are available to trade, or how the price moved previously in similar situations. Now, hold on to this analogy while I talk about the other technical indicator, candlestick patterns. There are a lot of different candlestick patterns that people generally use, but like I said before, they just indicate a location to buy or sell a particular stock. Let's say I'm looking at a 3-minute chart for a stock and a pattern is telling me it'll move one way, but if I look at a 5-minute chart, it's saying it'll move a different way. So I could get a completely different outcome depending on what I'm looking at. If I have a company with a certain market cap or float, then I could get a completely different outcome if I had a different market cap or float. Overall, you end up making a decision based on how a picture looks. For both pattern-based and calculation-based technical indicators, traders will backtest or simulate trading using previous information to verify the success of their strategy. Now, this is much better for making a decision. If I know that something has worked in the past, then it is much more likely to work in the future. To get an accurate idea of how well your strategy works, the testing can be quite intense with a lot of variables considered. But at least you get an outcome. This strategy works 75% of the time or 60% of the time. But with what criteria? Is it with one particular stock or a range of company sizes? Again, this is dependent on how intense your testing was. Back to the example of taking all your tests and putting them through a machine. Let's say now you know you have a chemistry test. And another twist is if you pass, you gain $1,000, but if you fail, you lose $1,000. The machine spits out that you have a 90% chance that you'll pass the test and you're likely to get an 80 out of 100 on the test. You're much more likely to agree to take this test now that you have this information. So now, if you know more about a situation that you're dealing with, in this case a chemistry test, and you have more stats on the outcome of the situation, you can make a much more informed decision. This brings me back to the title of the video. It's not always the case, but the majority of all alerts and signals are a lot like the first situation. Pass or fail a test, buy or sell a stock. Using price and volume to give you either a buy or a long alert, or a short or sell alert. There are a lot of these experts out there that will charge you for these signals or alerts, but they don't give you all the information to make an informed decision. So before you go and use any of these signals, just make sure you know what information you're really using.